Good day. This is a video blog on some basic finance things that I wanted to cover with you. One thing to make sure I reiterate here, in fact I've done that in my book as well as the rest of the blog post, is that I'm not a financial advisor, I'm not a CPA, I'm not an accountant, I'm just an average Joe that did some investigating and due diligence and made some major mistakes in life and kind of learned by the school of hard knocks to get where I am today. But one of the things that I wanted to talk to you about today came about as I was driving and listening to a local financial show in San Diego. And it kind of made me vindicated because about 6 years ago I had called this same financial show to ask about these non-traditional financial tools for retirement. And I was told at the time that what I was considering is not a good investment. On Saturday when I was driving down the 15, I heard that same talk show host basically say the exact same things that I had learned from a book called Missed Fortune 101 by Doug Andrews 6 years ago. So the premise of this blog is make sure that you run everything that I tell you by your CPA, by your tax advisor, by your attorney before you invest, okay? But I just want to give you the information that I learned almost 6.5 years ago and then put it into effect about 5 years ago. Alright, so let me see if I can actually kind of zoom in here for a little bit. Okay, one of the things that most people tell you is that when you put money away in a traditional retirement account like a 401k or an IRA, you are deferring taxes, and the point is that when you retire, supposedly you will be at a lower tax bracket. To the radio host's credit, he actually mentioned the same thing, that 30 years ago when he was going to school, this is what they taught him. But that is absolutely not 100% true. Some people may, some people may not, but it's something that you have to really think about, okay? And let's cover the whys, okay? One of the things that I'm sure you all realize is that tax deferred now does not mean tax free. Okay, that is very, very important. Tax deferred does not mean tax free. It means that you're just putting off when you're going to pay taxes on it. Okay, most of us, as we're going along our careers before retirement, have a mortgage. We may have children and dependents. So those are what the tax code allows you to deduct from your income, your taxable income, before you actually pay taxes. And you have to realize that the only things that are taxable are earned income, portfolio income, and passive income. Okay, so when you are retiring, true, you may not be getting a salary. However, you also, most of the time, will not have a mortgage anymore. Okay, so that deduction is now gone. Your children most of the time will move out of the house, so you cannot take those deductions. So these deductions are gone. And then lastly, what bothered me the most is the lifestyle. Why, after working 65 to 67 years of my life, would I even want to be at a lower tax bracket? So that really never made much sense to me when people told me that you're going to be at a lower tax bracket. Okay, so let's talk about now tax deferred. Okay, so which means that if I have this traditional retirement account like a 401k or an IRA, whatever I take out of it, I will have to pay taxes on. And I'm just taking this 25% tax bracket because it helps as easy math. So what I want to go ahead and discuss is the difference between what happens when I'm retired and what most people think will happen, or at least what I thought would happen. So I have put my money in these 401ks, and now let's say that I want $1 a month to live on. Okay? If I want $1 a month to live on, I have to realize that if I'm at a 25% tax bracket, I will pay 25 cents on that money when I pull it out. And that's where the tax deferred is not tax free comes in. When I pull money out of my IRA or a 401k at my retirement, I have to pay tax on it now as earned income. So based on losing all these deductions and getting my Social Security benefit or a pension, etc., whatever money I take out, I have to take the additional 25 cents out, pay taxes on it, and then I have my $1 to be able to live on. The other thing that I want to make sure that you guys understand is most 401ks work in the stock market. So they are also open to the risks of stock market. So what I want you to realize is that if I have a $1 in the stock market that loses 50% on a downturn, and I now end up with 50%, it doesn't take a 50% gain for me to get back at where I was. Because in order for me to get back to my $1, I have to make 50 cents, which is 100% recovery. You see where I'm going with this? So if I lose money, if I lose some of my principal, it takes 100% recovery to get back the 50% that I lost, just to get back even right here. Okay, that's why the preservation of principal is significantly important in any vehicle that you use. So what I was researching almost six and a half years ago was something called Indexed Universal Life Insurance. It is a life insurance policy. But it is a life insurance policy that, like Doug Andrews mentions in his book, is used for living as opposed to dying. Insurance companies are by far some of the safest companies as far as financial institutions are concerned in the world. For an example, when you put $1 in your bank account, the bank can loan $10 for every $1 that you put in their institution. That's how they get the leverage. That's where they make their money. Okay, but that's leverage is also the risk issue that hit us with this financial downturn. As opposed to that, an insurance company has to have $4 of reserve for every $1 that you have in their accounts. So they can't just willy-nilly go do investments, because they have to be damn sure that they are protected 4 times as much as anyone has money in their accounts. So that's why I wanted to go ahead and cover what exactly saved me and my family during these economic downturns. Okay, so I'm going to come back and go through that in a second. So we're back. I had to kind of reposition things and just to get the board in there. So this properly structured indexed universal life insurance works this way. Again, please make sure that you contact your tax advisor and financial advisor and run this through them. And I will put a link of the advisor that helped me with this, Zachary Hubbard. I'll put it on the blog. So if you guys are in the San Diego or Southern California area, you can contact her and she can go, you can contact him and he can go over all these with you. Again, Zach Hubbard. Or you can go to the Missed Fortune 101 website. Anyway, so let's kind of get to the meat of the matter. The way things worked was that a traditional IRA goes with the whim of the market. So when things are going good, absolutely we made very, very good gains. But when things tanked, we also made huge losses. And as we were discussing, whenever you take a loss, it takes a lot more to come back to even. The way index universal life works is it indexed to some kind of a metric in the stock market. For example, S&P 500. It doesn't have as strong of a gain during the good times. Maybe it is capped at 17%. But the main thing is that when things hit the fan, your principal is protected. So when everybody is losing money, those people that are in this form of investment get a minimum floor. For example, in this example, it was a 2% floor. So when everybody is taking a dive 30%, 40% in their portfolio, the people in this vehicle are gaining 2%. Again, when things go up, everybody makes up to the 17%. Again, when things are not so good, you're flat, or at least 2%. This is where the principal is protected, is when it comes in and uses these compounding effect to its maximum potential, because you're not losing your principal and it keeps on gaining. So one of the things that I mentioned in chapter 14 of my book is some tools, some creative ways of using this kind of an investment to do things that you may not be able to do. Because it is also very open and has very little restrictions. So what I want you to realize is that, for example, with a traditional 401k, you will not be able to pull it out until you're 57 and a half without any penalties. So if an emergency arises and you need access to your money, you're going to be paying through the mouth. I think about 10% penalty when you take money out of your traditional traditional retirement account. With something like this, you do not. You can take a loan, pay the current interest, but the most important thing on that is that when you take a loan, that amount that you have, let's say the $1 amount that you have, does not get deducted. So your $1, you take a loan, you're paying the interest back just like you would from a bank. But if I'm taking a 50-cent loan on my $1 total account, my $1 is still making the interest that the market is making, but I am using the 50 cents. If I was in my 401k, when I take the 50 cents out, now I only have 50 cents at play that will be making money. So that's another one of the advantages, where my money is always at play, whether I use the money and then I can pay it back when I can or not. The other thing is that when I retire, there is a clause in it where I can withdraw my money, my annual need, tax-free. And that's what I was discussing earlier, is that when you take tax-free, whatever tax bracket you are on puts you in that much more advantage. So if I need $1 to live a month, I pull out $1, not $1.25 to pay the tax. So all of these things is explained in, like I said, the book Missed Fortune 101, or the bigger one, Missed Fortune. They're both available at any public library, or I would suggest you have it for your own records. And also in the chapter 14 of my book, Roadmap to Life, I go through a little bit more detail of how this vehicle works. And I also have some links to people that help me in San Diego County. I hope this was educational for you, and I really hope you do at least investigate it. Get together with your accountant and your tax advisor and explore if this is something for you. If you are close to retirement, you can kind of check out to see if you are at a lower tax bracket or not. I'm not saying using your traditional retirement accounts is wrong, especially if you're getting a match by your employer. I would highly recommend that you go ahead and contribute to the maximum amount that the employer matches. But there are other tools available, and a lot of retirement accounts, you have a maximum amount. You know, if you are really doing well, I think the limit last year was if you're making over $250,000 a year, you cannot contribute to a Roth IRA, which is a little bit of a better tool. Because again, you're using after-tax dollars now, but your harvest is tax-free. So one of the questions that Doug asks in his book is, would you like to pay taxes on the seed, or would you like to pay taxes on the harvest? And talking together with my advisors and kind of thinking this out, 6 years ago I decided that I would rather pay tax on the seed and have my harvest tax-free. So I hope you enjoy this, and to your success until next week.